Have you ever wondered if a massive corporation could just hide its debts by shuffling paper around? Could a parent company use a tangled web of separate legal entities to create financial illusions? Overstate revenues, sweep liabilities under the rug? It's a fascinating question. And honestly, without a process called consolidation, the answer might just be yes. But thankfully for us, the accounting world has an ultimate truth teller.
Welcome to This Explainer. Today, we're demystifying consolidated financial statements. Now, if you're a focused learner trying to wrap your head around corporate accounting, you are absolutely in the right place. Look, consolidation is often viewed as this massive, intimidating mountain of a topic. It's notoriously considered one of the trickiest areas in financial reporting. But we're going to break down this complex 16-step consolidation process from our source material into an easy-to-follow, totally logical puzzle. By the time we're done here, you'll see exactly how all the pieces fit together. Okay, let's dive right into our roadmap for today. First up, we'll look at the concept of one single economic entity. Then, we'll tackle the acquisition math. After that, it's time for the great elimination process, followed by removing unrealized profits. And finally, we'll bring it all together with the final consolidated output.
All right, part one single economic entity. This is all about reality versus legal illusion.
So this really sets the baseline for exactly why we consolidate in the first place. The core narrative here is economic reality versus legal fiction. Basically, consolidated financial statements present the parent company and all of its subsidiaries as one single economic entity. And that holds true regardless of how many separate legal companies actually exist on paper. What we're doing is tearing down the legal walls between these companies. Instead of looking at each subsidiary in isolation, we want one true balance sheet, one true income statement, and one true cash flow statement. We do this to give stakeholders, investors, lenders, regulators, a completely unfiltered picture of the group's true assets, liabilities, and profitability.
So when do we actually have to consolidate? Well, under IFRS 10, a parent consolidates an entity whenever it has control. And control isn't just some vague feeling of influence. It exists only when you meet all three of these strict steps. Number one, you absolutely need power over the investee. Think voting rights or being able to appoint the board. Number two, you need exposure to variable returns like dividends or residual profits. And number three, you need the actual ability to use your power to affect those returns. If you hit these conditions, say, for example, you own 90% of a subsidiary, you absolutely must consolidate. There's literally no getting out of it.
Moving on to part two, the acquisition math. Time to crunch those day one numbers. This is where we look at exactly what happens on the very day a parent company acquires a subsidiary and officially gets that control. And it brings us to our first major hurdle, fair value. See, when you buy a company, you don't just take their historical book values. You actually have to step up their assets and liabilities to their true fair value on acquisition day. Take a look at this. The inventory's book value was $800,000, but its fair value is actually $900,000. The property, plant, and equipment jumped from $6 million to $6.6 million. And notice that intangible assets row? Zero book value, but a $900,000 brand value just appears out of thin air at fair value? It's kind of like accounting magic. We have to adjust for all of this before we can figure out what we actually paid for. Which leads us directly to a rather massive figure, $3 million in goodwill. So how do we get there? Well, it's a simple but absolutely critical formula from our source material. Let's say the parent paid a $10 million purchase price. You add the $2 million value of the non-controlling interest, those are the minority shareholders, that gives you $12 million in total value. Then you subtract the $9 million fair value of the net assets we literally just looked at. That $3 million difference, that is your goodwill. It's essentially the premium you paid above the fair value of the assets, and recognizing it is a strictly mandatory step.
Let's jump into part three, the great elimination process. Time to clean house.
Now, before we eliminate a single thing, we actually add everything together. Parent and subsidiary assets, liabilities, and revenues. It becomes one giant combination. But as you can imagine, that leaves us with a pretty messy house. And it's time to purge. Here's your checklist for that initial purge. Why do we do this? Mostly to prevent double counting. First, we wipe out the parent's investment account and the subsidiary's equity, their share capital and retained earnings. Those two things simply cancel each other out. Next, we eliminate intercompany balances. Think about it. If the parent owes the subsidiary $500,000, the consolidated entity can't owe itself money. So the accounts receivable and accounts payable simply disappear. Poof!
We also have to purge any intercompany fixed asset profits and any internal dividends declared between the entities.
All right, part 4, removing unrealized profits. This is the whole Step 11 versus Step 12 dilemma.
If you're going to get tripped up anywhere in consolidation, it's usually right around here when managing intercompany inventory sales. Notice the really hard line drawn between these two closely related steps. Step 11 says you must remove the entire intercompany sale and purchase transaction. We honestly don't care if the goods were later sold to an outside customer or not. Step 12, on the other hand, says you must remove only the unrealized profit that remains in the ending inventory, meaning the goods are still just sitting in the subsidiary's warehouse at year-end. The source text actually provides a fantastic, memorable analogy to help cement this concept. Imagine you move a laptop from your left pocket to your right pocket, and you pretend you just sold it to yourself for a profit. Step 11 steps in and says, listen, that sale never actually happened. You're just talking to yourself. So we remove the internal revenue completely. Then Step 12 looks at the laptop still sitting in your right pocket and says, hey, you still hold the laptop, so you definitely can't claim that profit yet. You have to reduce the laptop's value back down to what it originally cost you.
So the absolutely crucial point here is how this actually hits the financial statements. When we apply Step 11 to remove that internal sale, revenue goes down and cost of sales goes down by the exact same amount. Interestingly, the gross profit remains totally unchanged by this step. But when we apply Step 12 to remove the unrealized profit from the unsold goods, inventory on the balance sheet goes down and cost of sales on the income statement goes up. This makes sure that the inventory is carried at the group's original historical cost.
Finally, part 5, the final consolidated output. Let's put the puzzle together. Once all these eliminations are done, we're finally left with the consolidated statement of financial position, profit or loss, and cash flow. But let's talk about where people go wrong, because it happens a lot. Here are the most common mistakes in consolidation, straight from the source guide. First, as we covered, using book values instead of fair values at acquisition. Huge no-no. Second, forgetting that only post-acquisition profits belong to the parent. You don't get credit for what the subsidiary earned before you bought them. Third, ignoring the deferred tax that those fair value adjustments create. Fourth, forgetting that under IFRS, goodwill is not amortized. It has to be tested annually for impairment under IAS 36. And finally, missing the sneaky small intercompany transactions like internal interest, management fees, or loans. To avoid those exact traps, empower yourself with these highly actionable best practices. Use a standardized chart of accounts across all your group entities. It saves so much headache. Align your reporting dates before you even begin the consolidation process. Maintain highly detailed acquisition worksheets for every single business combination. Seriously, document everything. Where possible, use software to automate your recurring elimination entries. And always reconcile your intercompany balances before the reporting period closes. It minimizes those really messy differences at the end.
We've covered a tremendous amount of ground today, from identifying control to adjusting fair values and navigating the tricky waters of intercompany eliminations. So I want to leave you with this final provocative thought to ponder. If your corporate group's internal transactions were laid entirely bare right now, would the true economic reality match the legal illusion? Consolidation is the tool that strips away the fiction. Thank you for joining me for this explainer. Keep applying this structured approach and you'll never be fooled by financial illusions again.